Looking at a very bullish financial analysis on NVDA. The core argument is that the stock's break past 180 is just the beginning, all based on valuation and their product roadmap.
That's right. And a key theme here seems to be this overwhelming strength of the bullish case.
But I think the way it's presented might need some refinement for the kind of professional analysis report it wants to be.
I agree. The foundation is rock solid. I mean, there is really powerful, compelling data in here.
Absolutely.
But the delivery, the rhetorical framing, that could be elevated to really boost its credibility.
So that feels like the perfect place to start. The high-energy, almost hyperbolic language. It feels like it creates a conflict with the authority you need in a financial report like this.
Exactly. It's engaging, but maybe too much so.
Let's look at that section on the initial price move. It uses terms like explosion and says the price chose violence. And it even states the objective is data-driven hype. I mean, I see what they're going for, right? Capturing that urgency.
It's definitely impactful language, but I think the impact might be, counterproductive.
How so?
Well, the weakness is that the tone just leans so heavily toward that fear of missing out, the whole FOMO thing.
Right, the retail investor clickbait style.
Exactly. And that risks alienating the deeply knowledgeable readers. We're talking about the institutional side, fund managers.
The people who are looking for nuanced objectivity, even if they agree with the bullish conclusion.
Yes. And when the language is so emotive, it actually dilutes the analytical rigor you get from the PE and the PEG metrics.
But I wonder, though, couldn't they be aiming for that retail base on purpose? I mean, if the goal is just high visibility, getting a viral buzz, maybe that aggressive language works.
That's the core tension, isn't it? But the objective of a high-quality analysis should be to persuade with superior insight and data, not just pure enthusiasm.
I see.
When you title a section, The Explosion, The Hook, you're signaling that this is entertainment first, professional judgment second.
And the data here is so good, it should be its own hook.
Precisely. So the suggestion is to recalibrate the whole rhetorical approach. Keep the conviction because the data supports it, but let the sophisticated metrics, let the sold-out Blackwell pipeline create that urgency on its own.
So you're not relying on non-standard aggressive terminology.
You're letting the facts do the heavy lifting. We're asking the material to reflect the sophistication of the investor it's trying to reach.
Makes sense. So for some concrete examples, where would you start?
I'd start with the structure, the headings. Replace titles like The Explosion or The Moonshot Targets.
With something more neutral?
Yeah, something data-focused, like Technical Breakout and Momentum Analysis or Consensus and Street High Valuation Metrics. That immediately signals seriousness.
Okay, and what about the actual phrasing? The cheerleading parts?
We'll take the line about short sellers. The bears are officially in hiding. You could substitute that with a more measured look at the actual short interest data. Note the decline in the short float as validation of the move.
Or analyze the technical resistance points that failed?
Exactly. You use objective indicators, not just declarative statements about emotions. Show why the breakout was decisive with volume analysis. Don't just declare victory in all caps.
The goal is sophistication, not sensationalism.
Especially when the underlying numbers, like that forward PE of 38, are already so powerful on their own.
That shift alone elevates this from a market commentary to a serious assessment, so we've handled tone. Now let's talk about a gap in completeness.
Okay.
To really make this bullish thesis robust, the analysis has to systematically address the top 2 or 3 credible counter-arguments.
The potential risks, yeah.
Right now, it makes a really strong case for growth. It highlights the roadmap, specifically the sold-out Blackwell architecture and the promise of Rubin in 2026. It establishes that long-term story very well.
It lays it out very clearly. But the weakness is that the report focuses exclusively on the fuel, the catalyst for the rally.
Right. It treats the market like it's frictionless, like it's a guaranteed win.
And a complete analysis has to accept that the company's hypergrowth is also its greatest weakness. It brings intense scrutiny. It invites aggressive competition, none of which is addressed here.
That's clearly laid out. I wonder, though, if we've considered the significant risk that focusing solely on the product pipeline might overlook competitive threats or macroeconomic fragility.
That's the classic editorial challenge, isn't it? Acknowledging reality without killing your own argument.
But if you're truly a bull, you should be able to take on the bear case and dismantle it.
That's it, exactly. So the suggestion is to dedicate a mandatory section to key limitations and competitive headwinds.
And this isn't just a disclaimer.
No, it's a strategic move. It proves to the reader you've considered the disruptions. By doing that, you actually make your bullish conclusion much, much stronger. You're building a defensive moat around your own analysis.
So what are the specific risks we should prioritize? beyond just the general market slowdown. NVIDIA's lead feels so big right now.
The threat is subtle, but it's massive. Hyperscaler CapEx.
Ah,
As a concrete example, you have to analyze the risk from Google, Microsoft, Meta, Amazon, all of them pouring capital into developing their own proprietary chips, their ASICs.
that's the elephant in the room for sure. They're NVIDIA's biggest customers today, but their R&D budget shows they're building an alternative for tomorrow.
A good report needs to model that. Even if they have to buy NVDA chips now, their own ASICs could erode market share and pricing power in the long term.
So you need to analyze the timeline, the potential impact of custom silicon starting in, say, 2026 and beyond.
Right. Ignoring that huge quantifiable CapEx spend, it just diminishes the intellectual honesty of the whole piece.
And then there's the internal execution risk, right? With that aggressive schedule?
Precisely. You have to address the risk of that annual release cycle. Blackwell, then boom, Rubin in 2026. That pace is just unprecedented.
So you'd want to model a delay?
Yes, model a scenario where a platform delay happens or a serious flaw emerges. What if a quarter of projected revenue gets pushed back?
Showing that level of detail proves you've considered the downside and your conviction still stands.
Acknowledge the shadows. It makes the light you're shining on the strengths that much more persuasive.
Okay, that shifts the whole perception from cheerleader to informed strategist. So we've got tone and completeness. Let's hit the last section on analytical depth.
How to make this analysis proprietary, not just consensus.
Exactly. Well, the report does a good job summarizing analyst forecasts and the product schedule. It needs a sharper, more original angle to explain why NVDA deserves the premium implied by those Super Bowl targets, like 350. The argument right now seems to be that the valuation has compressed relative to earnings growth. It points to the forward PE being around 38 and the PEG ratio, basically saying NVDA is cheap right now.
That PE argument is the starting point, but it can't be the destination.
Go on.
The weakness is that just stating the current PE is 44.8 and the consensus target is 256. That's just factual reporting. It's not a novel thesis.
It's what every other firm is saying.
Right, so why is the reader here? The real analytical strength, the legendary moat for NVIDIA, is its ecosystem lock-in. It's CUDA. It's the software.
And the report focuses mainly on the hardware releases, on Blackwell and Rubin.
It feels like it's focused on the components being sold, not the integrated platform that they drive, which is the true source of their pricing power.
Exactly. So the suggestion is to pivot the analytical focus from what is being released, the new chips, to how the company is monetizing its ecosystem and widening that competitive moat.
And that provides a unique justification for the valuation. It turns a report from a forecast summary into an in-depth competitive breakdown that a reader can't just get from the headlines.
So how do you translate something technical like the CUDA moat into quantifiable financial analysis?
You have to connect it directly to the numbers, to margin expansion, to pricing elasticity.
Okay.
So for a concrete example, instead of just saying Blackwell is sold out, you analyze the specific margin expansion or the pricing elasticity that this incredible demand gives them for 2025.
So the question isn't just if they sell the chip.
It's how much flexibility do they have to raise the price and still sell every single unit. That's a much deeper metric than just top-line growth.
That makes total sense. If everyone needs your chips to even compete in AI, you control the price. The moat is less about the chip speed and more about the sunk cost of trying to build a competing software environment.
Exactly. You explore how the necessity of buying NVDA creates this high, quantifiable barrier to entry. You can actually model how much a competitor would have to spend, not just on hardware, but on developers and infrastructure to replace CUDA.
You're quantifying the cost of not using NVIDIA.
Yes, cementing that market dominance, the software lock-in, the developer network, that's what really justifies the premium multiple and the aggressive 350 target. You have to show the reader the mechanism behind the valuation, not just the resulting price.
That elevates the whole argument from a simple PE comparison to a really proprietary insight on competitive economics. This material has a great foundation.